In this video, we will learn about international financial management, the foreign exchange market. The foreign exchange market. Nearly $2 trillion a day of foreign exchange or forex trading daily makes the foreign forex market one of the largest market, one of the largest financial markets. It is made up of daily global foreign exchange turnover in millions of US dollars. This data is of April 2004. First one is sports. Sports takes up to 33% of the total financial market. That is 621,073 millions of dollars. And forward is actually 2,800 $208,333 million. Foreign swaps takes up to 50% of the market, which is 943,869 millions of dollars. Options take up to 6% of the market, which is 1,113 $113,608 million. The total forex market is actually 1 million dollars. The source is from Bank of International Settlements, Triennial Survey of Foreign Exchange and Derivatives Market, April 2004. The foreign exchange market. The spot market in foreign exchange is for immediate delivery on the spot or within 2 business days. Forward and future markets for future delivery or at settlement prices and volumes determined today for a specific future maturity. The foreign exchange market. Foreign exchange swap markets. Firms exchange or swap loans denominated in different currencies, usually for hedging purposes, acquiring a cash flow of payments in foreign currency that offsets receipts in foreign currency. Forex swaps are usually traded through a swap dealer. The foreign exchange market, options markets. A put is an option to sell foreign exchange, and a call is an option to buy foreign exchange at an exercise price at or before some future specified date. An American style option may be exercised on or before its expiration date. A European style option cannot be exercised before expiry. A floating exchange rate system. Supply and demand in the foreign exchange market determine the equilibrium exchange rate in a floating exchange rate system. The equilibrium rate is approximately the midpoint of the bid and ask rate, or bid plus ask divided by 2. The bid is what a bank pays for a unit of foreign exchange. The ask is the price at which it sells a unit of foreign exchange. Foreign exchange quotations. Forex is quoted in two ways. First one is European quote. Second one is American quote. The foreign currency price of $1 is European quote. The dollar price of a unit of foreign currency. American quotations. American quotations look like this. The bid and ask. The euro Japanese and pound. The bid is 1.2184. 1.2187 is the ask, and 1.2184 is 1.2184 is actually bid. European quotations. As a rule of thumb, 1 divided by bid in one quotation equals to the ask in the other, and 1 divided by ask equals to bid. A dealer purchases at the bid rate and sells at the offer or ask rate. This is the bid and ask spread. Second one is the bid ask spread. The difference between the ask and the bid rates represents profits to the foreign exchange dealer. EFX. EFX and RIC BID ask contributor. The bid ask spread in example. At the bid and ask prices, Rabobank trades 100 million euros. It buys 100 million euros at 1.2184 US dollar and sells them at 1.2187. The bid ask spread 1.2187 minus 1.2184 equals to 0.0003. That is 3 basis points or pips in terms of foreign exchange. Rabobank dollar profits on the 100 million traded equals to 0.0003 into 100 million equals to $30,000. The dollars per euro and millions of euros per day. This is the chart of supply of euros and demand for euros. The bid is for 1.2184 and the ask is for 1.2187. So that alone equals to $30,000 of trade. A fixed exchange rate systems. A fixed exchange rate system usually has a ceiling and a floor intervention points. The central bank purchases dollars at the floor price and sells dollars at the ceiling to maintain the exchange rate within a band. At 1.01 pesos per dollar, the supply exceeds the demand. Consequently, the price falls to 1. At 0.99, there is an excess demand for dollars. So the peso price of the dollar rises to 1.2, 1.00. That is the equilibrium. A central bank purchase of dollar. When the supply of dollar is greater than the demand for dollars at the floor price, the central bank purchases dollars at the floor price and adds them to its foreign exchange reserves. At a floor price of 0.99 pesos per dollar, the central bank purchases $3 million at 0.99 pesos per dollar. The $3 million are added to the central bank reserves. The central bank could sterilize the immediate impact on the domestic money supply by selling 0.99 into multiply $3 million pesos in domestic bonds on the open market. A central bank scale of dollars. When the demand for dollars is greater than the supply of dollars at the selling price, the central bank draws from its reserves of dollars and sells them at the selling price. The sale of reserves just equilibrates supply and demand at a price of 1.01 pesos per dollar. Neutralization would entail a purchase of domestic bonds equal to 1.01 multiplied by 3 million pesos. However, the loss of dollars would continue and ultimately leads to an exchange rate crisis. The monetary effect of Forex intervention. Sale of foreign exchange reserves automatically reduce the domestic money supply. Neutralization or sterilization policy. A central bank buys $1 million worth of treasury debt. Purchases of foreign exchange reserves automatically increase the domestic money supply. Neutralization or sterilization policy. A central bank sells $1 million worth of treasury debt. The euro irrevocably fixed exchange rates. The launching of the euro. Euro banknotes and coins have been in the circulation since January 1st, 2002. The 12 member states of the Eurozone were Belgium, Germany, Greece, Spain, France, Ireland, Italy, Luxembourg, the Netherlands, Austria, Portugal, and Finland. On January 1st, 2002, previous national currencies were withdrawn from circulation. At inception, it was worth $1.18, sank to $0.85, and then rose to a peak of $1.35 before stabilizing somewhat at $1.25. The launching of the euro. Consequences. Cost of conversion are disappearing. The bid and ask spread has gone to zero for banknotes and coins, and wire transfers are less expensive. Forex reserves is no longer necessary in the Eurozone. Exchange rate volatility is zero, so options are worthless. European interest rates have converged since currency risk in the Eurozone is eliminated. Capital markets are enjoying lower interest rates virtually everywhere in Europe. The SWIFT International Clearing System, the Society for Worldwide Interbank Financial Communication, that is called SWIFT, has over 1,000 members for whom it provides secure electronic transfers of monies and communication of messages and internationally. Each member bank has an electronic identification. When the bank ID is confirmed, transactions and communications can take place swiftly and securely since the computer system is a dedicated one. Clearing House Interbank Payment System. SWIFT is connected to CHIPS, that is, Clearing House Interbank Payment System, in the US, which handles tens of thousands of transactions and transfers billions of dollars internationally per day. Member banks make electronic payments in cheap dollars during the day, and at the end of the day, the system nets the sums to be paid, then transfers only the net amounts. Verification, confirmation, and authentication of transactions is also carried out by the CHIPS system. Uh, Purchasing power parity. So purchasing power parity means if a commodity can be purchased in one place and sold in another without any transport cost, tariff, no transactions cost, its price should be same in both markets. This is known as the law of one price. Example, the price of the product in yen is multiplied by the spot dollar price of the yen to yield the same price in the United States. Absolute purchasing power parity. So absolute purchasing power parity means absolute PPP states that exchange rates correspond to consumer price indices of similar commodities in each country. That is S equals to PUS divided by PJ. The spot exchange rate can be inferred from commodity prices in different markets. That is the reasoning underlying the economist Big Mac hamburger standard. So the Big Mac index is here, and this is hamburger standard. So in United States, the Big Mac price in dollars is $3.06. In Argentina, it is $1.64. In Australia, it is $2.5. In Brazil, it is $2.39. In Britain, it is $3.44. In Canada, it is $2.63. In Chile, it's $2.53. In China, it is $1.27. In Czech Republic, it is $2.3. In Denmark, it is $4.58. In Egypt, it is $1.55. In Euro area, it is $3.58. In Hong Kong, it is $1.54. In Hungary, it is $2.60. In Indonesia, it is $1.53. In Japan, it is $2.34. In Malaysia, it is $1.38. In Mexico, it is $2.58. In New Zealand, it's $3.17. In Peru, it is $2.76. In Philippines, it is $1.47. In Poland, it is $1.96. In Russia, it is $1.48. In Singapore, it is $2.17. In South Africa, it is $2.1. In South Korea, it is $2.49. In Sweden, it is $4.17. In Switzerland, it is $5.05. In Taiwan, it's $2.41. In Thailand, it's $1.48. In Turkey, it's $2.92. In Venezuela, it's $2.13. In Aruba, it is $2.77. In Bulgaria, it's $1.88. In Colombia, it's $2.79. In Costa Rica, it's $2.38. In Croatia, it's $2.5. In Dominican Republic, it is $2.12. In Estonia, it's $2.31. In Fiji, it's $2.5. In Georgia, it's $2. In Guatemala, it's $2.2. In Honduras, it's $1.91. In Iceland, it is $6.67. In Jamaica, it is $2.70. In Jordan, it's $3.66. In Latvia, it's $1.98. In Lebanon, it's $2.85. In Lithuania, it's $2.31. In Macau, it's $1.40. In Macedonia, it's $1.90. In Moldova, it's $1.84. In Morocco, it is $2.73. In Nicaragua, it's $2.11. In Norway, it's $6.06. In Pakistan, it's $2.18. In Paraguay, it's $1.44. In Qatar, it's $0.68. In Saudi Arabia, it's $2.4. In Serbia and Montenegro, it's $2.08. In Slovakia, it's $2.09. In Slovenia, it's $2.56. In Sri Lanka, it's $1.75. In Ukraine, it's 1.43, and for UAE, it is $2.45, and in Uruguay, it is $1.82. The arbitraging Big Macs. Arbitraging a Big Mac, buying low in China and selling high in the US has high transaction cost. The arbitrage profits are this formula. The cost of arbitrage include the purchase of yuan at the ask rate and the purchase of a Big Mac in China at purchase rate. The payment, insurance, and freight charges to ship the Big Mac to the US. It's this. The payment of US customs duties on prepared food is this. Finally, we sell the Big Mac in the US, paying the sales tax there. The law of one price. The law of one price to exactly hold taxes, transport cost, import duties, and the bid-ask spread must all be zero. In this case, the arbitrage in either direction imposes the strict law of one price. Clearly, the condition does not hold for non-traded goods or no goods subject to high transport cost and tariff. The relative purchasing power parity. The relative purchasing power parity only that changes in the change. Exchange rate reflect the inflation rate differential between countries. The expected appreciation of the foreign currency equals to the expected inflation rate at home minus the expected inflation rate abroad. The monetary approach to exchange rate. If different movements in price levels cause movements in the exchange rate, it is natural to ask what causes different inflation rates internationally. The old view that inflation is too much money chasing too few goods is not far from the truth. When money grows faster than income, price tends to rise. Consequently, countries that inflate their money supply relative to the supply of goods experience higher inflation and greater depreciation of their currencies. The monetary approach to the exchange rate. This is known as the monetary approach to the exchange rate. The quantity theory of money states MV equal to PY, where M is the money supply, that is currency plus checking deposit, and V is the income velocity of circulation of money. P is the price level, the implicit GDP deflator, and Y is real GDP. The monetary approach to the exchange rate. The price level is thus determined by P equals to MV divided by Y, an equivalent but insightful way of defining income velocity as the inverse of the demand for money as a fraction of income. That is, we may express the price level as the ratio of money supply to money demand. That is, P equals to M divided by KY, where M is the money supply and KY is the demand for money. The higher the money supply relative to money demand, the higher the price level. The monetary approach to the exchange rate in terms of percentage changes over time in indicated by a load indicated by a dot over the variable. The rate of inflation is determined by growth in the money supply relative to growth in money demand. Inflation is caused by too much money chasing too few goods. Compounded initially acceleration in the income velocity of money. The monetary approach to the exchange rate. In a steady state equilibrium, the demand for money as a fraction of income remains constant. We have the simple case of inflation caused by money chasing goods. The seigniorage finance of fiscal deficits. The seigniorage finance of fiscal deficits is often known as the printing press. In a sense, money is the root of all inflationary evil. It helps to understand why inflation bursts out here and there periodically. Seigniorage finance of fiscal deficit. To avoid inflation, any third grader as governor of the central bank would follow a simple Milton-Friedman rule to maintain a low, constant rate of growth in the money supply to avoid inflation. The problem is that the issue of money seigniorage is often the finance of last resort of fiscal deficit. For example, if the fiscal deficit is 10% of GDP, and 3% can be financed by borrowing at home and 2% can be financed by borrowing abroad. The residual 5% finance must come from the printing press or the seigniorage. Seigniorage finance of fiscal deficit. New money must be issued when bond finance is insufficient. This is the equation for new money bonds, where dB divided by dt is the sale of domestic bonds and dd divided by dt is the sale of foreign bonds. In this context, dm divided by dt is interpreted as new seigniorage. Seigniorage finance of fiscal deficits. Another way of expressing inflationary finance is as the inflationary tax, multiplying and dividing the left-hand side of 3.6 d by m yields, where this is the percentage inflationary tax rate and m is the inflationary tax base. Limits to inflationary finance. There is a limit to the amount of inflationary tax since high inflation renders money a poor stores of value. Consequently, money demand collapses, that is, velocity accelerates. The collapse in money demand exacerbates exacerbates inflation. Inflationary episodes, Peru in the late 1980s, are often the result of collapsing a real GDP. A fiscal deficit equals to 20% of GDP financed solely by new money issue and accelerating velocity. Inflation made the entity worthless, so the currency had to be changed by a currency reform adopting the new sold. Limits to inflationary finance. Countries that rely more heavily on inflationary finance witness currency depreciation. This suggests that purchasing power parity is founded on the growth of money supply relative to the growth of money demand. The monetary approach to China. China's inflation is a puzzle. The percentage increase in China Consumer Price Index in 2005 was only 1.8%, despite high money growth at 17.6%. This is due to some prices being controlled, particularly fuel and gasoline. However, the implicit price deflator, a broader measures, rose to 3.0% more accurately, reflecting inflation, a strong factor keeping inflation down. In addition to 9.9% real growth in GDP, is the rise in demand for money relative to income in China, 4.3%, a sign of financial deepening in Ronald McNan's terminology. The monetary approach to China, there is a greater financial intermediation due to an income elasticity of demand for money equal nearly to 2. Here is summary for 2005. Increase in implicit GDP deflated at 3.4%. Increase in money supply, that is equals to money plus quasi minus money, is 17.6%. Increase in real GDP is 9.9%. And increase in demand for money as a fraction of nominal GDP is 4.3%. The monetary approach to China. These results are based on application of the monetary approach to China. Had money demand not increased relative to income by 4.3%, the inflation rate would have been 7.7% in terms of the actual outcome. The great advantage of the quantity theory of money is that it provides a basis of estimating the difference in expected inflation rates, thus providing the foundation for the theory of purchasing power parity. That is, the level of exchange rate is determined by the relative money supplies and money demands. Movements in the exchange rate are due to movements in relative price levels. Thus, relative purchasing power parity as a monetary phenomena can be expressed as this formula. More rapid monetary growth at home causes the home currency to depreciate, as does less rapid real economic growth. By the same token, a fall in domestic money demand compared to foreign money demand also depreciates the home currency. This is known as monetary approach to the exchange rate. Deviations in exchange rates from purchasing power parity can, however, result from real shocks and changes in the terms of trade. For that reason, it is useful to have a measure of real exchange rate to capture changes in the exchange rate relative to the purchasing power parity rate. The concept of the real exchange rate is simple one, measuring the cost of one country's goods in terms of another. The real exchange rate. A bilateral real exchange rate is defined as RER equals to P divided by SP, where P is the price level at home and SP is the foreign price level expressed in terms of home currency. When domestic prices rise relative to foreign prices, a real appreciation is said to take place. This means home goods can buy more foreign goods because a positive deviation from purchasing power parity has taken place. Real dollar depreciation, the real exchange rate. The real dollar depreciation, a dramatic example of the real depreciation of the dollar in terms of the euro, has been the increase in the dollar price of the euro from $0.90 to $1.55 from 2005 to 2008. While there has been little difference in the inflation rates, the euro has thus experienced a real appreciation while the dollar has suffered a real depreciation. Naturally, there are many currencies, so the best RER measurement is one that takes into account the weight of each currency in terms of trade. The IMF provides such a calculation. The real effective exchange rate. The IMF real effective exchange rate (RER) measures the price of a home country's goods in terms of foreign goods, where and this is the equation for real exchange rate. When the home country's price rises relative to another country's, a real appreciation takes place. It costs fewer home goods to buy foreign goods. When foreign inflation is higher than domestic inflation, a real depreciation occurs. It costs more home goods to buy foreign goods. Future contracts. Future contracts are standardized contracts per currency traded on the floor of an organized exchange, usually Chicago or Philadelphia. Futures have fixed maturity dates, usually less than 1 year. Each future contract corresponds to a fixed amount of foreign exchange. For example, 100,000 euros. Prices are determined by the Chicago method of open outcry. Initial margin is required as collateral. The position is marked to market daily. Margin maintenance is required. The broker may make a margin call to restore margin collateral. If not restored, the broker may liquidate the position. A single commission is paid for the round-trip purchase and sale, as well as the bid and ask spread. There is no counterparty risk as the exchange rate guarantees the contracts. Trading hours are regular exchange hours, but recently electronic trading takes place on the 24-hour basis. While liquid, the future market is small in size. Delivery rarely takes place. Forward contracts are on the other hand are any size and maturity desired, with maturities occasionally longer than a year. For this reason, the forward market is known as the over-the-counter market. Trading occurs between firms and banks in the interbank market, with prices determined by bid-ask quotes, the spread providing profits for the banks. Standing bank relations are necessary, but not margin collateral. Banks are connected 24 hours a day via the SWIFT system and negotiate forward prices directly. In volume, the forward market dwarfs the future market. It is mainly used by firms to hedge operational exposure. Forward contracts for hedging. International businesses hedge their risk through the forward market. Forwards give them the flexibility in terms of size of contract and maturity dates. Forwards do not require the firm to tie up working balances in margin deposits. In forward markets, money markets, and swap markets, there is counterparty risk, broadly defined as downgrading, either partial or complete, of the terms of financial contract. Commodity and future forex. Commodity and forex futures. Similarities. Future and forward contracts are agreements to exchange an underlying asset, such as gold, at an agreed price at some future date. Futures and forward contracts may be used either to manage risk or speculative purposes. Differences: a forward contract is negotiated directly between counterparties and is therefore tailor-made, whereas futures contracts are standardized agreements that are traded on an exchange. Although forward contracts offer greater flexibility, there is a degree of counterparty risk, whereas futures contracts are guaranteed by the exchange on which they are traded. Differences: because futures contracts can be sold to third parties at any point prior to maturity, they are more liquid than forward contracts. Futures prices are determined by the carrying cost at any time. These costs include the interest cost of borrowing gold, plus insurance and storage charges. The cost of a futures contract is determined by the initial margin, the cash deposit that is paid to the broker. Positions in forward contracts. A speculative position in forward contract is the uncovered forward uh, purchase or sale of an asset or commodity for delivery at some specified date in the future at a price F that is determined today. A short sale may be financed by borrowing the asset from a broker to be returned later. A short position in gold. A short position is the sale of gold for delivery at maturity at a price F. The short seller covers the position by buying at S in the spot market at maturity. The profits losses per unit of gold are Fs per metric ton, the contract unit in gold. If the spot price of gold is greater than F, the trader loses SF per, per ton in covering the forward contract. If F is greater than S, the trader gains. The payoff for a forward sale of gold at the price F are shown by the negatively sloped line. A short position in gold. Numerical example. Suppose you sell 500 ounces of gold short for delivery in futures market at $422 in 3 months. In a short sale, an investor borrows shares or gold from a brokerage firm and sells them, hoping to profit by buying them at lower prices. If they rise, the investor faces a loss. Uncovered short sales are those shares or gold that have been borrowed and sold, but not yet covered by repurchase. Gains from a short sale of gold. If the spot price falls to $400, 3 months later, when you cover your short position, you gain $22 per ounce or $11,000. Losses from his losses from a short sale of gold. If the price of gold rises in the spot market to $444, you lose $22 an ounce or $11,000. A long position in gold. A long position in gold is purchase of gold for forward delivery. If the spot price upon maturity is higher than the forward price, the trader gains SF per ton. If the spot price is less, the trader loses FS. The payoff is indicated by the positively sloped line. Gains from a long position in gold. Suppose you buy 500 ounces of gold at $422 for delivery in 3 months and the spot price rises to $442. You gain $20 per ounce or $10,000 by paying $20 per ounce below the spot price. Suppose you buy losses from a long position in gold. Suppose you buy 500 ounces of gold at $422 for delivery in 3 months, but the spot price falls to $402. You lose $20 per ounce or $10,000 by paying $20 per ounce above the spot price. A hedged position in gold. A hedge position is the combination of a long and short position of the same amount and maturity of a security or asset. What is gained on the long position is lost on the short position, and vice versa. Graphically, the hedged position is sum of the long and short positions yielding the horizontal axis in the figure on the right, a zero payoff. The cost of carry. Take the following step. Borrow S at interest rate R today. Purchase 1 unit of security for S today. Sell forward at F for delivery of 1 unit of the security in 1 year. At maturity, cash in the dividend. K is delivered the security at the agreed price F, then pay off the loan. The cost of carry. The no profit arbitrage condition requires F minus S equals to R minus K multiplied by S, where R minus KS is the cost of carry. In terms of percentages, the gain on the forward sale is just offset by the cost of carry. The difference between the cost of borrowing and the rate of return is the cost of carry as a percent. Covered interest arbitrage. It is possible to risklessly arbitrage short-term fund, taking advantage of interest rate differentials in treasuries relative to FX discounts or premia in the forward market. In general, if the UK Treasuries pay 22% more than US Treasuries and the forward pound is at less than 2% discount, say 1%, and arbitrage gain can be realized, in this case 1%. 2% is gained on the interest differential and 1% lost on the forward sale of the pound. Covered interest arbitrage. To focus on strict interest rate parity, the no arbitrage profit condition. We ignore the foreign exchange and treasuries bid-ask spread to take advantage of small profit opportunities by arbitraging short-term liquid capital. Take the following two steps. Step 1. Compare dollar to dollars. Route 1. With $1 billion by 90-day US Treasury bills at maturity, they will yield principal plus interest of 1 plus R US million dollars. Each dollar invested yields R US dollars minus quarterly rate in 90 days. Covered interest arbitrage. Route 2. Buy 1 upon S million pounds sterling in the spot market at S. Invest 1 upon S pounds sterling in 90-day UK Treasury bills, yielding 1 upon S multiplied by 1 plus R UK million pounds in 3 months. Sell this much pounds sterling in the forward market at F, yielding F upon S multiplied by 1 plus R UK million dollars at settlement in 3 months. Covered interest arbitrage. Step 2. Select the higher dollar return. If this equation places short-term capital in UK treasuries due to the higher yield, that is, sell 90-day US treasuries from your portfolio. Buy pounds spot. Buy UK 90-day treasuries. Sell the pound proceeds forward for delivery in 90 days. You have completed a round trip and gained the covered arbitrage differential. Step 2. Select the higher dollar return. If this much amount place short-term capital in US treasuries, Due to the higher yield, that is, sell 90-day UK treasuries from your portfolio, buy dollars spot, buy US 90-day treasuries, sell the dollar proceeds forward for delivery in 90 days. You have completed a round trip and gained the covered arbitrage differential. Covered arbitrage interest. However, if this much covered interest rate parity holds, there are no unexploited arbitrage profit opportunities, so do nothing. Covered interest parity can also be expressed in terms of the percentage interest rate differential versus the percentage premium or discount on the forward pound, which says that the interest rate differential in favors of US Treasuries is just approximately offset by the premium on the pound sterling. Covered interest parity can be depicted graphically, which says that on the interest rate parity line, the 1% interest rate differential in favor of US Treasuries is offset by the 1% premium on the pound sterling. Uncovered interest arbitrage. Uncovered interest arbitrage takes place when the exchange rate risk is not covered in the forward market. The investor sells the proceeds at subsequent spot rate in 90 days. Since ES90 equals to F90, it is generally true that expected arbitrage gains are zero when interest rate parity holds. Uncovered interest arbitrage. An uncovered interest arbitrager gains when the sale of foreign exchange is at higher than expected price. For example, at $1.27 rather than $1.25. So it starts with $10,000. Then let's say treasury bills in dollars in 3 months is at the rate of 0.96%. So it will finish with $10,096. And if it is converted to euros divided by 1.25, that will be 8,000 euros on the spot. And let's convert it to treasury bills in euros in 3 months at the rate of 0.90%. That will be 808,072 euros in 3 months. Then sell euros forward at $1.27. So the net amount will be $10,251.44. And uncovered interest arbitrager loses when the sale of foreign exchange is at lower than at the expected price. For example, at 1.20 rather than 1.25. So it starts with $10,000. The treasury bills in dollars in 3 months is at the rate of 0.96%. It finishes with $10,096. Now, if we convert it to euros, so that will be divided by 1.25 and it becomes 8,000 spot euros. Then it will be converted to treasury bills in euros in 3 months at the rate of 0.9% interest. Then the final amount will be 8,072 euros in 3 months. Then we will sell euros at spot in 3 months at 1.20. So the net amount will be 9,686. $46. A foreign exchange swap. In a direct counterparty swap, a German firm borrows euros and a US firm borrows dollars. They swap the loans, the German firm servicing the dollar loan, the US firm servicing the euro loan. Each firm hedges its ongoing receipts in the foreign currency at a lower borrowing rate than it could obtain by direct borrowing. So the German firm will has a loan obligation in euros to the US firm, and the US firm is giving principal and interest in euros to a German bank. Then German bank is giving a loan in euros to the German firm. A call option, an option to buy Forex. The Black-Scholes formula for the premium for a Forex call option, and this is the formula. C equals to SE to the power of minus PT and D1 minus XE to the power of RT multiplied by N multiplied by D2, where C equals to the value of the European style Forex call option, T equals to the time of the option's maturity in years, S equals to the spot price of the underlying foreign currency, X equals to the option's exercise price, and R equals to the continuously compounded US risk-free interest rate. P equals to the continuously compounded risk-free interest rate, and this equals to volatility, the standard deviation of the returns on the exchange rate. A call option, an option to buy Forex. A call option has greater intrinsic value. If immediately exercised, the further it is in the money. So call option is actually premium and intrinsic value. A put option, an option to sell Forex. The Black-Scholes formula for the premium for a Forex put option, where P equals to XE to the power of RT and minus D2 minus SE to the power of minus PT multiplied by N multiplied by minus D1, where P equals to the value of European style Forex put option, T equals to the time option's maturity in years, S equals to the spot price of the underlying foreign currency, X equals to the option's exercised price, R equals to the continuously compounded US risk-free interest rate, P equals to the continuously compounded foreign risk-free interest rate, and this equals to volatility of the standard deviation of the returns on the exchange rate. A put option, an option to sell Forex. A put option has a greater intrinsic value if the immediately exercised, the further it is in the money. So this is put option. Put option is actually premium and intrinsic value. So this is the intrinsic value, and here this is the premium. And this is the strike price, and 100 is the spot price, and we have the time value option here. So in conclusion, the foreign exchange market provides for currency conversion and hedging against unanticipated changes in the exchange rate. The resources devoted to the foreign exchange market are the bid-ask spread and commissions. The movement toward common currency areas such as the euro facilitate trading commodities and assets by reducing the transactions cost associated with different currencies. So that is the end of the foreign exchange market, and we have learned about these topics in this video. So this was international financial management. And the subtopic was the foreign exchange market. Thank you.